Hi, Mark Dannenberg here with Options Moneymaker. We're talking about simplifying your trading for bigger profits, and we're going to continue our discussion about using simple charting tools. We're going to identify on a chart on one of our indexes ideal trade entry points. We've already learned how to identify the directional bias, but now let's identify what some ideal entry points are, and we're also going to talk about exiting a trade. So we're going to take a look at a chart here of the NASDAQ 100. I'm looking at a 30-day, 30-minute time period. Now for me, 30-minute and 60-minute time periods are the ideal time period to use for making trade decisions. I'm going to go back through the chart here in the last 30 days, and I'm just going to randomly pick out some entry points which, in my opinion, would be ideal entry points for trades. One of the most obvious to me here is right here. This was on the 17th of September. The price bar on our 30-minute bars moved above our 2 and 3 standard deviation Bollinger Bands. That pattern all by itself tells me there's a strong likelihood we're going to see a movement lower. Think of the movement outside the Bollinger Bands as an overreaction to whatever is going on in the market. And we did see, in fact, a movement lower. So that is an ideal entry point, even if you're just trading off of the Bollinger Bands. But in connection with trading outside the Bollinger Bands, there was also a level of resistance that we were trading right around. So there were two indicators telling us there's a high likelihood that we're going to see a movement lower in the price of the index. This is an ideal time to get into a declining bias trade. A rising bias trade is the reverse of that, where the price may exceed the lower Bollinger Band as well as be trading at a level of support. So you want to get into a rising bias trade when you see the price below the lower Bollinger Bands or right at the Bollinger Bands. Below is better, at is good, but if it's also in conjunction with trading at a level of support, there's a great opportunity to enter a rising bias trade. And you can see here that there was actually follow through for a very short-term quick profit within a few hours after that, where we moved up above the Bollinger Band and would have had a nice profitable trade there. Here's another entry that the price was trading right at a strong line of support. This line of support was declining support, had already been identified by one level of natural support, was being identified by a whole series of natural support levels, was also trading slightly outside the Bollinger Band, and then we got the movement higher. So this is a good entry point to get into a rising bias trade. Sometimes there is not the follow through that we anticipate. So here was a good entry point. We saw it move above the Bollinger Band, but it was not at any kind of level of resistance. So if you're trading just on the Bollinger Bands, you might have gotten into a declining bias trade, and then you were in that trade for a while and may in fact still have been in that trade. Now we typically like to identify opportunities to get in that will give us a pretty quick rapid profit so that we can recycle our capital. Sometimes we end up being in the trade a bit longer. We're still waiting for the next down cycle, and that will be coming soon based on my opinion. When that down cycle comes, if we had gotten into a declining bias trade back here, even though it worked against us for a while, it will actually be able to give us an opportunity to take a profit at some point in the future. And that might only be a month away. So a month might be short-term trading for many of you. Short-term trading for me is I like to be in and out of positions in a matter of days. Here's another opportunity. This was a very strong opportunity. Strong because it was a natural level of support. All the prior price points before it were higher lows. The price points after it were higher lows. But we wouldn't have known at the time where those price points after it were going to form. We have to make our decision based on what we see. And what we saw at that time is that it was trading outside the lower Bollinger Bands, so that's point number one for a rising bias trade. And it was trading at a strong line of sideways resistance, and it was trading at a declining level of support. I'm sorry, it was trading at a strong level of support, strong long-term level of support, as well as a declining level of support. So you have three indications all right in that time frame that say most likely we're headed higher, and you can see what happened after that. So entry points are also exit points. If I was in a declining bias trade and I was holding on to that trade and I saw this pattern form right here, because I know that that's a strong bias to the upside, now is the time to exit out of the trade and take my profit. If I'd gotten into the trade when it was trading at resistance and the upper Bollinger Band, and I'm still in that trade trying to hold on for more profit, now's the time to get out, because that pattern right there is telling me that there's a strong bias to the upside. If I was in a rising bias trade and I had moved up to the upper Bollinger Band into an area of resistance, that is the time to get out of the trade. Having channels identified, bracketed by support and resistance, and using Bollinger Bands is one of the simplest ways to identify clean entries and clean exits. It's time to get out of the trade and harvest your profit, or this is a great opportunity to get into a trade.